Welcome to the Greyhawk DJC podcast. In today's podcast, we speak with Ian Jones, a loan officer at Integrity Mortgage Corporation of Texas. We hope you enjoy the podcast. Hey Ian, how you doing, man?
I'm good. How are you doing, friend?
Pretty good. Thanks for doing this. I know we don't know each other, but thanks. Welcome to the show.
Absolutely. No, I appreciate getting asked to be on.
All right. So you are a loan officer, right? Specifically for homes, right?
Yep. Home loans exclusively, no commercial, none of the crazy other loan types, just homes.
Sure. And so just for the audience, tell us what a loan officer does, what you think the basic tenets are, and all that stuff.
Well, a loan officer, simply put, helps someone facilitate the purchase of a home. So that's going to be making sure all the financing is in order, making sure that it follows all of the Fannie Mae, Freddie Mac guidelines, and getting it sold off to servicing and getting someone into their home.
Okay.
And the core tenets of that for me personally are just absolutely do right by people and over explain, for clarity purposes, just to make sure that they understand exactly what they're getting into, what it's going to take, and what it's going to cost to close out on their property.
Okay. And so just so we get to know you better, so we go back in time, take us through the journey. How'd you get involved with home loans? Take us back to where you're from, a little bit about yourself, I guess.
Okay. So, where I'm from, actually, I was born in Oregon.
Okay.
And then from Oregon, my family moved to North Carolina. And then from North Carolina, we moved to Texas. And then I grew up in Plano and went through all the schools within Plano and had, a few odd jobs in between things I was doing. And then that kind of was a foray into doing marketing full time for a painting, roofing, gutters, windows, and siding company.
Okay.
And I was with them for about a decade. We experienced a lot of really good growth. And, there comes a breaking point in how many hours you're willing to work and put into something that isn't your baby. And I kind of reached that point with doing the marketing for the company and ended up just quitting one day. I came home on lunch. My wife was there on summer break. She's a teacher. And I just said, hey, I think I'm going to quit today. I'm going to put in my 3 weeks.
How old were you at this time?
Let's see. I would be probably 32.
Okay.
That sounds right.
And when did you join the company?
31, 32. And I joined up with Integrity Mortgage where I work now.
Okay.
At the end of 2019. And we all know what came later on after 2019.
Did you know anything about mortgages before then?
So I'm in a pretty different spot than a lot of other LOs. So my wife and I, we would buy and sell homes a lot, like our own personal homes.
Oh, really?
So that way we could, get to the next house, next house, next house. So we bought our first house and we sold it, made that money, put it into the next one, so on and so forth. And so I just was really familiar with the mortgage process in general, simply because I'd done it so many times with just buying our own personal homes.
Okay, so this is homes to live in, not rental homes.
Correct. Correct. Right. Just solely to live in.
What made you want to switch so many times, or you just like doing the process?
Well, it started with our first house we bought in Wiley, which at the time we both worked in Plano. So that commute was getting kind of old.
Okay.
Driving 30 minutes a day. They were always working on the roads. It was just a nightmare. You get off of work at 5 o'clock and you'd be home by 6. So we both got really, really tired of that. So we bought a house in Plano, and the house was significantly smaller than our other house. And we redid the entire thing from top to bottom. And then we had our first kid, and then we were thinking about having another kid, and we knew that the house we were in wasn't really going to facilitate what we were trying to do. So we sold that house, bought another house in Plano, a bigger house, and stayed there for a hot minute. And then we recently, in 2023, we sold our house in Plano and moved back to Wiley, because now there's really no commute for me because I get to work from home.
Right. But back then it was easier to do this because rates were lower. Homes were cheaper, right?
I think when it comes to that side of things, yes, rates were lower, right? But rates were at 4% back then, 4 to 5. That's just kind of wherever you would land within that. And the houses, I wouldn't say were necessarily cheaper per se.
Okay.
Right now what we see a lot of is the prices on these houses are coming down, like more closer to reality and where they should be, right? Because when COVID hit, it really smashed the housing market nationwide on everybody going up in value. And in doing that, now with the rate environment, it all feels really off kilter.
Right.
And I mean, I agree, totally with that sentiment that, the affordability does feel really wonky right now as far as houses go. But back then, I mean, buying a house for $315,000 and, your salaries and all those things back in that time, I mean, to me, it feels almost identical because, that was 2000. Oh my gosh, what would that be? We bought in 2016 in Plano. And then when we sold that house, I think we sold it for $425. We bought it for $315, sold it for $425. So, I mean, that's the COVID equity that really, introduced that to us. Normally it wouldn't be like that. That's wild. In a normal market, you're looking, 3 to 5% in value year over year on your home.
Okay.
But yeah, I mean, I think right now the affordability does feel kind of out of reach for a lot of people, but that's simply because people forget you can buy down your rate and you can have other people pay for that, meaning the sellers. Right now, there's more homes for sale than there are buyers, meaning that it is totally a buyer's market in Dallas-Fort Worth. And you can challenge me, anyone can challenge me on that because the data set proves it.
Even with all the people moving into Dallas.
Correct.
Wow.
Absolutely 100%. I mean, the biggest takeaway here is I see the contracts after they come in on a property. So let's just take this beautiful home we're in, for example. Let's say it was on the market for $1 million, right? By the time that's negotiated, it may come down to about $800,000, and the sellers are paying title and giving them a little bit of money for rate buy down.
Wow.
So a lot of people are taking advantage of that right now.
Are the rates brought down that much though?
Yeah, the rates can be brought down pretty significantly with a buy down or a temporary buy down or anything, right? Because we all know what goes up must come down, right? And so we're at a crescendo point with rates where at some point they will come down.
Okay.
And when they do, I would rather be on the I'm refinancing end versus the I'm buying end, because the pent up demand for homes is really great right now. I mean, honestly, it's insane. I mean, it's palpable, right? And people are just waiting for a magic number. If it hits 599 as your standard par rate, and par just means that there's no rate buy down, that's just the rate you can get, application side. It's going to be a feeding frenzy again because the houses have continued to decline in price, and now the rate's at 599. Suddenly, house prices are going to come back up a little bit, and the market demand's going to be there.
Okay.
I mean, I think about it a lot. I mean, there's people right now that I call it reactivated, where they had kind of just stopped looking because it was so chaotic and they just couldn't find anything. A lot of buyers through the COVID times just, in fact, closed one up the other day where they could not get a house to save their lives. They had made something like 60, 70 offers in 2020, 2021 and just couldn't get anything.
What is causing that?
Well, the rates were so low back then that everybody and their grandma was clamoring to buy a house, right?
Sure.
Everybody was on the work from home kick, so they're all trying to get more space because their apartment wasn't suiting them, and people were overpaying for houses. Even during COVID, I even tried to talk people out of buying houses. They would be like, "Yeah, we're buying this house," and I'm like, "Well, it says it's listed for $350, and you guys offered $400," and they're like, "Yeah, we know. That's how we're going to get our deal in." I was like, I don't think that sounds right. And then we'd get the appraisal back, and the appraisal would be like $360. I'd be like, so somebody's got to pay the difference because you signed an appraisal waiver, meaning that whatever it appraises for, you're going to cough up the difference.
Wow.
And they're like, okay. And so they would pay, the additional $40,000 needed. And I would just be like, hey, I don't think this is a good buy. I think this is not a great idea. They're like, oh, but my rate is 2%. I'm like, yeah, but it's not a good idea because at some point you could go underwater with this thing. And unfortunately, I mean, we're seeing some of that.
Are they doing that because there's a bidding war happening?
Oh, yeah. There was all kinds of bidding wars back then, man. I mean, those are the war times, And I think a lot of people are scarred from it. And then they get scared right now because of where the rates are. The thing is, you can genuinely buy a house with ease right now and get a phenomenal deal. Your rate's just going to suck for probably the next 2 to 3 years.
So when the rates come down, you just refinance it. Basically.
Exactly. Yeah. I mean, that's what we did when we bought our house. just to use easy numbers, let's say I bought my house it was listed for 300,000. Offered them 270, and then I asked for $10,000 in concessions. This is back in 23. This is before it kind of really took a nosedive, and they took the offer. And so I'm just waiting to refi, because you can never change what you paid for your house, but you could always refinance the rate.
Right. Wow. And so how do these big corporations buying homes for rental purposes affect the market then?
Well, I mean, they're taking homes out of the market, right? That's the way to think of it.
And is that a real thing? Are these companies
It's very
doing
real.
this? Okay.
Yeah, very real. I mean, everybody always, talks about BlackRock. BlackRock being one of the biggest investors in this category. And they do own a lot of houses. I mean, there were times when entire developments, new developments put on by builders would just sell the entire neighborhood to an investor.
Oh, wow.
They would strike up a deal. Here's the entire neighborhood. There you go. And now it's a part of the portfolio. And now everybody in that neighborhood is a renter.
Wow. And so the builders just do that for the purpose of making money, but now you just have a bunch of rental homes. No one actually owns a home in that neighborhood, right?
Yep, correct. No one actually owns a home in that neighborhood. But everything comes home to the chickens come home to roost. I think that's the expression, right? Mm-hmm. And they're experiencing a lot of heartache with those purchases, and they're having to offload properties. But it's just right now, the investors really aren't buying as many houses, to my knowledge, as they have in the past, and which is a good thing, because that means there's more houses available. But the last number it took was there's 750,000 more homes available right now than there are buyers.
And this is Dallas.
This is the nation.
The nation, okay.
Yeah, I mean, when you hear things like, inventory's tight, it's always going to be tight in certain neighborhoods. It's always going to be tight in certain cities, right? Just because of its location. And once it's built out, it's built out, right? You just can't go back on that. Mm-hmm. But there's a lot of builders that are giving crazy incentives to buy houses and buying down the rates to nothing, doing everything like that. So there's a lot of ways for people to get into a home right now. With relative ease. It's just, the way everything's been pushed on all media sides is all rates are high. And everybody's waiting for that one move to make it happen. But the problem is, if you wait for that, it's going to be too late.
Do you think the Fed's going to reduce rates?
So Fed's reducing rates really has nothing to do with mortgage, unfortunately, with the way mortgage rates go. When you really look at it, right? Mortgage rates are determined by two pieces. Mm-hmm. You have your 10-year treasury.
Okay.
And what that is, and the 10-year treasury, for the rates to go lower, you want the 10-year treasury to be lower. Then you have mortgage-backed securities. Okay. And you want those to be higher, and that means rates go lower.
Can you explain that? Because I'm not familiar with any of that. So
Yeah. So and this is, my cursory understanding, because if I go too deep into something, I will lose my mind, right? Sure. And I don't want to lose my mind over something as inconsequential as, these things, because I just need to focus on helping people get into homes.
Right.
But basically, when the Fed funds rate is what the Fed funds overnight money with to banks. So when banks, I heard an interesting story from, I think it was NPR, banks essentially go broke overnight. And they have to pull in money, and they borrow the money. They borrow the money from the federal government. And the federal government borrows that money to them at whatever that rate is that's established. Okay. And then they lend out that money to other banks, et cetera, and just, goes across the entire nation. So that money is what's affected, and that's really short-term money. And 30-year mortgage is not short-term money. That's long-term money.
And this is the rate that the Fed sets, right? Mm-hmm. Okay.
And the Fed sets the overnight funds rate. That's how you can look at it.
Okay.
So any short-term loans are on that rate.
Okay.
So that's going to be things like your car. What else? There a bunch of different things are on that.
A short-term loan, like less than 5 years or 10 years?
Yeah, I believe that's how they kind of look at it.
Okay.
Yeah. But the Fed funds rate is just kind of like an early indicator of, hey, we feel like there's something economically that could possibly be going wrong, and we need to make money cheaper. Mm-hmm. And that's how they stimulate the economy, right? So it could be, and that's the goal of the Fed, right? They want inflation to be 2% or below, and they want unemployment to be between X and X. And that's the only thing they have to control it with is the Fed funds rate.
Right.
So what we should all be really looking at is what the 10-year treasury is doing.
Okay.
And what the mortgage-backed security is doing. Because if the 10-year treasury is down, That means mortgage rates are down.
Sure. Sure.
I mean, because you took 2024, there was a 100 basis point cut, meaning 1% on the Fed funds rate, and it did nothing for mortgage rates. In fact, mortgage rates went up, and you're like, well, how could that be? Well, it's because they really have not a whole lot to do with each other. One funds overnight, and the other one is long term.
Okay. So you just mentioned two things that affect the actual mortgage rate. What was it again? The Treasury?
Yeah, the 10-year Treasury.
Okay.
And mortgage-backed securities.
Okay. Can you explain what those two are?
The 10-year Treasury is debt, as far as my understanding goes, so anybody out there can correct me, is what in 10 years they anticipate that money to be worth or financed against. Again, not super well versed in this. This is not my area of expertise. I watch them to see, hey, is today going to be better or worse?
But there is a rate for that. Yeah.
There is a rate for that, exactly.
Right.
And as of this morning, it's like 4.3 whatever.
Okay.
And it is continuing to go down. It's been going down this entire week.
Sure.
And then the mortgage-backed securities, you can think of it, if you've seen The Big Short, where they packaged up all of these different types of loans, et cetera, in a package of 10 years, right? Their maturity, they're paying out, whatever, and people buy them. So when they're worth more, interest rates go down because that package of, and again, our system is so convoluted here in the United States on how things operate that it's very difficult to dive into it and understand it and then make decisions from there.
Sure.
But simply put, if the 10-year T is down, interest rates are down. You can watch that one indicator, and that tells you everything you need to know.
Sure. So how did those two things affect the mortgage rate then?
To be honest with you, it's in my mind, it's a bunch of voodoo and hooky dook.
Right.
I'll never understand it because if I get too deep into something, I will lose my mind on it.
Well, it's the mortgage-backed securities that caused the financial crisis several years ago. And people don't realize that the banks were buying really bad mortgages.
Yeah,
right?
really bad.
That shouldn't have been bought legally, right?
Or even been made for that matter, right? And that's why Fannie Mae and Freddie Mac they're no longer private entities. They're partial government entities. So the government can make sure that this type of stuff doesn't happen again because they were doing ninja loans. That's no income, no job, no assets, right? And now, I mean, we get in the weeds about, doing loans, especially during COVID with self-employment. Oh my gosh, that was wild. We had more things we had to grab for self-employed people during the COVID times than we did in any other time.
Right.
Yeah.
Oh my gosh. All right. So we started this with your story.
Yeah.
You got here.
Yeah.
But so go back. So you quit your job and then what are you doing after that? Yeah.
So I decided I was going to kind of stay in the same field, home improvement, right?
Okay.
We'll call it. And I started a pressure washing company in Plano. And I knew how to get leads for it. I mean, because that's my background, right? And got a bunch of jobs, was doing jobs all over everywhere. And then one day I get a call from my loan officer that did all my loans. His name is Brandon Hearn. And he called me up and he goes, hey, what are you doing? I heard you quit your job. I was like, yeah, I quit and now I'm doing pressure washing. He's like, nah, stop that. I'm like, what? He's like, yeah, dude, go ahead and stop that. You need to come do mortgages with me. I'm like, man, I don't know. It just sounds like, he's like, nah, dude, you'll be fine. It's going to work out. And I was like, okay. So I shut that thing down and I went and, got my license and then, got a job at where I work now, which is Integrity Mortgage. And the rest, as they say, is history.
Can you take us through what the licensing process is like?
Ooh, man. Yeah. Okay, so you got to do, there's a place there's several of them, Champions Real Estate. And you got to take the classes. And I think it's like 3 or 4 days.
Okay.
And you do the classes, you do the courses. And then you have to pass a written exam afterward. And you have to pass that exam with, I believe it's either between a 70-75% to get your license.
How many hours of classes are there again?
I think it's 20 hours.
Okay.
20 hours of classes or something of that nature. Because you have the federal licensing portion, and then because Texas is Texas, you have the Texas portion too. So there's like hours for Texas and hours for the federal part.
Okay.
And then you have to go in and take the exam. But the exam is built for people to fail because they don't want, everybody and their grandma originating loans. So the pass fail on it is 50%.
Oh, wow.
So if the more a question is missed, that question gets pushed back into the mix to become harder and harder. So it's like a self-fulfilling prophecy with this exam. Because the more questions people miss, that's what gets pushed up, because they don't want everybody passing.
So do most people take several times before they pass?
I mean, I've had other friends that decided they wanted to get their license. And so out of those 2 people, only one person didn't make it.
Okay.
The first time through, or the second time through. And then on the third time, third time's the charm. They got it.
Okay.
But
Is there a certain number you fail, you can't do it anymore? Or
I am not sure on that front.
Okay.
I've never had anybody run it that far up the clock with it,
Right.
But for me, I studied for 2 weeks solid.
Okay. So not only the classes, but you're studying.
Yeah. Because
time,
there's just a lot of different things you got to know and understand about the process and about legalities and all those kinds of things, right? And I took the tests, and I, thank God, passed it the first time, and then got signed on at Integrity, and immediately was like, I gotta make business now.
Right.
Like, there's no leads handed to you.
Right.
In this world. Well, I mean, where I'm at anyway, right? And so I was like, okay, there's no base. This is purely commission. So I've got to figure out how to get business.
Are most loan officer jobs like that with no base?
Yeah, I would venture to say probably like 80% of them are without a base. There's that 20% that are bases, and it's going to be at companies like your Rocket Mortgage and like all the really, really big players in the field. And those guys just get run through the ringer, man,
right.
Over at those companies. As soon as you base is involved, you're going through the ringer, right? So I was like, oh man, I really got to get business in. Like, that's it. Like, this is do or die, right? So, and it was 2019, mind you, the end of 2019. And we didn't know what was coming next, right? And then 2020 hits, and everybody I've ever talked to is like, hey, you got to get belly to belly, and you got to meet people. You got to meet realtors. You got to do this, and, you want to ask them for their business, et cetera, et cetera. And I was like, okay. And then, boom, COVID hits, and it's like lockdown city, right? There's no way to really meet anybody in person at that moment because we're locked down, right? I mean, restaurants are closing. They're only doing takeout, et cetera. So I just sat in my office at my house, and I made a video. And
where'd you put the video?
So that video ended up going to probably 50 or 60 realtors. So what I did is I made what I'll call now a generic video that was like, hey, my name's Ian, and I do home loans and all this other stuff, right? And then I strategically found, realtors that were doing a level of volume that I thought, hey, some of this could be purchased, and I could be a part of that. And I sent them the video, just apropos of nothing, man. Cold open.
Nice.
And that turned into a couple of people that I still work with to this day.
So you individually sent the videos. You didn't like post it on YouTube or Facebook or anything?
Nope.
Okay.
I just sent it to them directly to make it seem a little more personable, right?
Okay.
And, that pulled me in a couple people, and I'm like, okay, all right, cool. So this seems to be working a little bit.
Mm-hmm.
So I took that and just started making content in general, about mortgage, about whatever. Did a few like fun things where I would like interview realtors with random questions and stuff over Zoom. And it really, helped catapult my business into, where it is today, so to speak. Because in my first year, I did $9 million in origination.
Oh, wow. And what's your commission on that? Or may I ask?
It's enough. It'll pay the bills.
Okay.
Let's just say that.
But there's a percentage rate you get.
Correct.
Right?
Yeah.
Okay.
Yeah.
Right.
And that's set by the company. I don't set any of that stuff. And I was like, okay, I made it through year one. And then year two, hey, I did like $10.5 million. All right, let's go.
So it's unusual for someone brand new and for year one to do $9 million, right? I mean, doesn't seem normal.
I'll be real about this. I have no idea. I just know that the desire to feed my family, make sure our roof stayed over our head was far greater than anything ever. And whether that's good or not, it meant that I put food on the table.
Right.
But I mean, am I proud of that number? Absolutely, right? I mean, 9 million, that's a lot of millions, right?
Right.
I mean, the average LO does like, the equivalency of 1.5 deals a month. And, to be in that category of 9 million, you're doing like 3.5 deals a month.
What's the average size of a deal in Dallas?
Right now, I would say the average size of my deals, because that's the only metric I really have, because I feel like everything else kind of skewed. Average size of my deals is about 350.
Okay.
350, and that's after down payment, all that kind of stuff, because that's what we do.
Is that in line with the average cost of a home in Dallas?
Well, the average cost of a home right now, I think, is $440 in the Dallas area.
Okay.
In the Dallas area, but is that in line? Yeah, for sure, sure. Because you got a lot of people that will take advantage of your first-time home buyer programs, where you can put down 3% on conventional, and 5%. So they may be buying a $400,000 house, but that loan's still gonna be like $380, right? So. Yeah, I mean, the average size is pretty good. I mean, back then in 19, it wasn't as big as it is now. I mean, it's obviously increased over time, right?
Yep.
But yeah, doing 9 million back then, and then 10.5 the following year. And then I think I did 12 the year after that. And then we've just kind of settled into a groove right now because of just uncertainties within everything of doing about 10 million a year.
Have you had any down years?
Yeah. Oh yeah.
Okay.
Yeah. Last year was a really down year. I mean, people are they don't know what to do, right? They kind of put those things on the back burner. And I feel like a lot of uncertainties for people play into that, right?
What do you think causes the uncertainty?
Am I going to have a job tomorrow?
Okay.
Will something that gets put into place remove my position from a company? I know that's a big fear for a lot of people, is just not knowing if they're going to have their jobs tomorrow, right? And, with different things happening, through the U.S., and we can use tariffs as an example simply because it's a big unknown, right?
Right.
A lot of people are worried with tariffs, coming through, that they may not have a job because now it costs the company that they work for, 25% more to manufacture said good. Well, companies can't really take that. And so maybe their position's eliminated because they need to save the money, right? To be able to continue to produce a product. Which is, it's super depressing. But, there's still a lot of people in tech and everything else in the Dallas area that, they don't think like that. They don't think that my job could be gone tomorrow. They're just moving forward, right?
Yep.
And I think that the biggest piece for 24 being a more down year was, one, I took my foot off the gas, which is my fault, and two, the uncertainty of just everything moving into. There's that lame duck time between presidents, right? Normal occurrence where pretty much nothing happens,
right? Which
during the lame duck, that was like my slowest time, right? But this year's just been on again, off again, the wildest year I've probably ever had.
Is it much better this year, I guess, or how's it looking for you?
Well, I put my foot back onto the gas pretty hard.
Okay.
So it's on a pretty significant rebound for me personally. But I know realtors and lender friends of mine that it's been a really, really tough year, and they're my friends and stuff, so that kind of super sucks. I hate seeing my friends not be successful.
Even if it's a buyer's market, it's still not good for them, I guess. Because
the narrative, and I shouldn't say narrative because that makes it sound really conspiracy theory, but like the news that gets ingested by everybody right now, it just continues to espouse how interest rates are really high.
Right.
And the stuff that gets buried are the things that are what can help make an informed decision for somebody, and that's going to be things like, there's more houses available now than basically it's been in the last decade, right? Sellers are slashing prices. They're giving concessions. They're giving you money towards buy down on your rate. All those things are not being talked about, but that's what I get to see all the time. And so me and my 250 followers, across all platforms, like I'm telling them all about it, And the people that end up buying feel really good about buying because they know that there will be not another point in time in history that they'll be able to buy their house at that price point. Just think about it for a second, right?
That is really interesting you're saying that, because you're right. Everything that's on the news, it seems like it's such a dire situation. But you're saying that there's things that you can do to mitigate against this, and no one really talks about this. Right?
Absolutely. And no one talks about it because, I mean, what makes the best headlines and what gets the most clicks, and, you know, unfortunately, due to just what we all know, it comes down to rage baiting, right? And rage bait gets the views, gets the clicks, gets the everything.
Right.
So as long as you're espousing the things that doom and gloom, people are going to listen and watch because they love to be rage baited. I think it's, and I fell into this too. It's an addiction. Being rage baited is an addiction, and you've got to break it. And that's really what I did this year. I broke my rage bait addiction. I mean, I'm reading every day now, setting time aside to read and do those things instead of consuming content.
Right.
I mean, of course, I'm still a part of that ecosystem because that's what drives business, right? That's me putting my foot on the gas. But like, just stop consuming that media in all its shapes and forms, right, left, center. It doesn't matter. I mean, and you'll feel a lot better. I mean,
because it's not reality a lot of times. Like you're saying in your industry, you can do things, but no one really thinks about that.
Correct.
Right? Yeah.
Yeah.
Wow. So when you said you put your foot on the gas, aside from the content you create, what other things do you do to get in front of customers and stuff?
Well, I mean, my biggest referral source will always be realtors, right?
Okay.
No one ever goes to the lender first. We would be changing, you know, decades upon decades upon decades of thinking to make that happen.
So like an individual doesn't just come to you naturally.
No, they go to the realtor first.
Okay.
They always have, and they pretty much always will, right? There's no way for me to change that. But what I did is, I just started finding agents that I would like to work with. And I would find a mutual. Like Facebook, social media is such a great place to be able to network, right? Okay. Virtually network with people. And I'll find somebody and I'll be like, hey, I work with so-and-so already. I would love the opportunity to, like, you know, hang out, shoot some content. Because that's what's really reactive now is content. Right. Like everybody's doing content. And you want your lender to be somebody who wants to help you grow your business versus just wait for a phone call. And so for me, that's what I've always done is like, hey, I know you have no idea who I am, but I already work with your friend so-and-so. And I was wondering if you wanted to go make some content at your listing that you have. And they're like, well, sure. Then we go hang out. And then once we've hung out, like they realize, hey, I'm not a bad guy. In fact, I really want to help them. Because at the end of the day, I do. I believe in the law of reciprocity, right? You help someone get what they want, and inevitably they'll help you get what you want, right? And there's agents that I've been, you know, trying to not necessarily coerce, but just work with for years. Right. And right now it's coming to fruition because I see the cracks within the facades of the person that they're currently working with. Because that person is literally just waiting by their phone for that person's lead to call them or for them to call them with a lead. And I think that is the wrong way to be doing it in 2025. Give them more things right.
So let me ask this question then, since you mentioned that. What is the difference, in your opinion, between a good loan officer and a bad loan officer?
So a good loan officer is going to allow for availability, right, with their client. And they're going to make sure that they over-communicate clarity. So something that I do that, I picked up during the Rona times is after somebody submits an application to me, I'll review it, do all the things, get it ready, and have their pre-approval ready. And then I'll say, hey, we need to set up a Zoom. What day works best for you? They're like, oh, Tuesday at 6:30. I'm like, great, perfect. I'll set it up, send it out. And then we get to the Zoom and I show them everything. I pull back the velvet rope. That really is the big difference between a good loan officer and a bad loan officer. Because if you're trying to communicate this big abstract purchase to somebody who's never bought a home before over the phone, there's going to be a lot of room for confusion. Right. Right. And so on the Zoom, I always tell them, hey, it can take 30 minutes or it can take 3 hours. It's up to you. It's your time. You can ask as many questions as you want. There are no dumb questions when you're basically buying a Lamborghini. And we'll do the Zoom, and then I'll do the grand finale, which is go down to the pre-approval, put the numbers in, and then email it off to everybody. And then everybody understands. And then I always try to get them to follow me on any social media that they have.
So that sounds very basic. So there's actual loan officers that don't do this? Like,
I would I would say probably 99% of LOs don't do this at all.
Wow. Okay. So you just kind of rush people through the process, give
Absolutely.
general
100%.
question answers. Okay.
Or never pick up their phones. I mean, that's something that I'm finding right now is like I'll get somebody a new, borrower, and it'll be because that loan officer didn't explain anything to them, and they're just really frustrated. They don't know what's going on, and they just want answers, which I get. I mean, when you're making a purchase that size, you want to know where all the money's going, and that's it. And so I'm there to communicate all that. No problems. There's the velvet rope. Come on right behind me. Let's go. You know,
Right.
Any answer you want, I'll give it to you. Even if I don't want to tell you, I'm going to tell you anyway because it's the truth.
Sure. So in this whole process, what are some of the biggest points of confusion you've seen from people?
I mean, one of the biggest ones, and I still can't believe it's one of the biggest ones. This blows my mind that you had to put 20% down.
Right.
That one, it's like, no, you don't. I don't know how that has not been dispelled at this point. But you can put down 3% on conventional, which most people have no idea you can do on a first-time home buyer program.
So that seems like to be out there in the ecosystem that you put 20% down. Mm-hmm. How does someone get to 3% then? What?
All you have to do is not have owned a home in the last 3 years. That constitutes you as a first-time home buyer.
Okay.
So if you haven't owned a home in 3 years and you go to buy a house, you can put 3% down to purchase that house.
Wow. So that's a big point of confusion. Yeah.
I mean, as I go through all this stuff, it really is. I mean, I've had conversations with people who are like, "Hey, I just don't think I'm ready to buy a house. I don't have my 20%. I don't have X, Y, and Z." I'm like, "Well, what do you have?" They're like, "I got this." I'm like, "Okay, you can do that with that." Like, and they're like, "What? No way. I can buy a house." Yeah, you can. You can buy a house. And that happens quite a bit. And I think the other big thing is when people do their, this is going to sound so pointed, but it is. So Zillow, when you look at a house on Zillow and you it shows you the payment estimator on it, it's only showing you principal and interest. It doesn't show you the remainder of the numbers until you kind of click through. And so a lot of people will, set up a Zoom, get their pre-approval, do all the things, and I'll show them, hey, show me a house that you like and let's run numbers off of that house. Because in Texas, every house could be identical. They may have different values on the property tax rolls, okay? Which means one pays more, one pays less.
Okay.
And so some houses are like crazy high in property taxes and the value, et cetera, and some of them are not. So I run it through and they're like, "Oh my gosh, well, Zillow said this was going to be like this much." I'm like, well, you got to have your property taxes and your homeowner's insurance. And in Texas, those are two really big pieces of the puzzle right now. And I think what contributes more to the unaffordability crisis we were kind of going through earlier, right, is the cost of insurance, homeowner's insurance.
Yes.
It's wild. I mean, example, my house, my policy in 23 was $4,800 for the year. Okay. No, sorry, that would be 24. 25 renewal comes up. It's $8,800. So I've had zero claims, zero anything.
Almost double.
Yeah.
Right.
Almost double.
Yeah.
And a lot of people, they don't look at their homeowner's insurance on an annual basis. They just let it happen. And that's where I think the insurance industry has kind of scammed everybody again. I mean, I get it. Texas has had a lot of claims. We've had all these things, right? But at the end of the day, most people cannot take a, 100% increase in their homeowner's insurance and then be blindsided by it, right? So that's one of the biggest things, in my opinion, that's contributing to it is the fact that homeowner's insurance for some people is like $500-$600 a month for, a nice 3-bedroom, 2-bath, 1,500 square foot house, which is crazy because we used to be able to peg that number at like $125 a month with ease, right? And now it's just so all over the map. But
what do you think the cause of this is? Is it really that hard for the insurance companies, or are they doing this on purpose, or is it both, I guess? Or
this is Ian's thoughts. These do not represent anyone else in my orbit's thoughts. Sure. I mean, at the end of the day, insurance has its risks and it has its shareholders, right? And anytime you have shareholders in any type of business, you have to produce profit, right? To pay back the shareholders, to continue your value to grow, et cetera, right? And so as long as you have that in place, they're always going to get their money, period, right? So if they pay out $1 billion in claims, well, then they're going to try to make $2 billion off of everybody that year to make back for their claims, right? So everybody pays for claims. Like I've had no claims, yet mine was going to go up to this amount. That's crazy to me, but it's because I'm offsetting everybody else in that area, in that zip code that did make claims when they had problems, right? And then now suddenly everybody's a higher risk category, or a zip code's a higher risk.
Right.
But it really comes down to, profit, and they have to make margin, and they've got to, continue to grow for stockholders, for everybody else, because our entire system is kind of predicated upon everybody's retirement's tied up in stocks. Everything's tied up in stocks, right? So we can't have, certain variables fall, which causes people's portfolios to fall, 401ks to drop, etc. So we all just kind of, in a way, fund each other's retirement, right?
So what I'm curious about is, have the number of claims gone up for legitimate reasons, or is this being artificially propped up? Because it seems like the velocity or the rate at which your insurance premiums are going up is much faster than previous times, right?
Correct.
So
correct.
Why the sudden velocity?
Well, it's fired, in my opinion, by a lot of different things. One of which is the fact that, the costs of goods have gone up, right? So if it costs, $200,000 to rebuild the house from sticks back in 2020, and now it suddenly costs $400,000, now they're having to insure a $400,000 house, right? Versus a $200,000 house. So that does increase your premiums, but they're also, materials have gone up. Everything's kind of really gone up in price, right? And we haven't kind of seen the end of it, because now we have all these tariffs that could be coming down the pike that everybody's uncertain of.
Right.
And companies, made a big blitz and bought a bunch of stuff. And it's like, it affects every market when you put tariffs on the building goods, right?
Right. So it's the general state of the economy that's doing this, I guess. Uncertainty.
Well,
plus,
if I had to pinpoint it down to one thing, is corporate greed. Because that's really where my head's at on it.
And that's sprinkled on top, obviously.
Yeah.
Wow.
But yes, there's a lot of contributing factors that they point to say, well, we're going to go, it's like, at the end of the day, it's like health insurance, right? We pay exorbitant amount of money for health insurance that doesn't work for us, and we still pay.
We're getting a little bit off topic, but I'm just concerned that there's going to be a breaking point, right? Wages cannot keep up with this.
Correct. And you know what? I have seen a reprieve. Okay. We're not going to rage bait people. I have personally seen a reprieve, right? So again, policy in 24, $4,800 for my homeowners. I sent it over to another friend of mine who does insurance. We got it to $5,100 a year.
Okay.
Same coverage, same everything. But that's the problem, is they anticipate you not doing any of those things and not shopping the policy and just increasing it and pulling it from your escrow.
So that's nefarious. If you don't complain and you're a good client, they'll increase it, and then you have to do it you have to take your own time to find something that's more compatible with your wages.
It's the same thing with property taxes in Texas, right? You fight them every year. And so you win some, you lose some, and then you get hit on that value for what you pay, right?
Yeah.
So, it sucks because it adds a layer of due diligence to everything. It just can't be set to autopilot, right?
Yep.
And so now every year before, it pays out of escrows, you got to check to make sure that your policy is what you want it to be. Call your person and say, hey, what's my renewal going to be like, right? Because everything just gets lost in the kerfuffle. And I've learned my lesson on that one, and I will never let that happen again. Because I could have been paying, $8,800 for the year.
And it's something no one thinks about, because they just they're busy with their work and their own business.
Because your insurance renews on the anniversary of when you closed your house. So if you closed your house in January, January 1st, right? You're not really thinking about anything like that on January 1st.
Right.
Right. Everybody knows property taxes are paid out at the end of the year. Okay. And they send us stuff in the mail all the time. It's like, hey, we think your value is this. You can protest now, blah, 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 right? They get sneaky with insurance, man. I don't know if it's intentional or unintentional or whatever, what the legality is, but they were just going to do it and not even really give me a chance to say yay or nay. They're just like, all right, here's what it's going up to, and we're pulling it on this date. I'm like, wow, that sucks.
And then it's on you to change.
Yeah.
Wow.
So,
all right. So pretend like I'm a first-time home buyer.
Okay.
And I come to you. Take me through the entire process. Like, what am I looking at? What do I have to do?
Okay.
And I know nothing. Yeah.
So obviously, we're going to pretend in our scenario that you already have your down payment together, maybe a little bit of closing costs, et cetera,
Okay.
right? And you've been working your job. You've been working at least for the last 2 years. That's what people get confused. You don't have to be at the same place for 2 years because, come on. You know, if you don't like somewhere and they're abusing you, leave. Okay.
How much of a gap can you have between jobs?
I mean, you can have a gap of, up to a year as long as you can explain why you had a gap.
Okay.
But we just need 2 years of employment.
Sure.
So even if there's a 6-month gap, 5-month gap, whatever, as long as you can explain why there was a gap, what was going on, it's good to go. I mean, especially on conventional loans.
Sure. And what's the average down payment nowadays?
I mean, for me, it's hovering right at about 10%.
Okay.
I would say. But most people really like to take advantage of the first time home buyer 3% down, right? And then get the house, because the less you put down, the better your rate. And you go, oh, that doesn't make any sense.
Really?
Well, the reality is, if you put 3% down versus somebody's putting 20%, you have to carry mortgage insurance, right? And mortgage insurance eats into how much house you can buy because they offset it by the rate.
So if I put 3%, I don't need mortgage insurance?
No, if you put 3%, you have to have mortgage insurance.
Yeah, that's right.
So if you put 20% down, there's no mortgage insurance. Right,
Okay.
right.
Yeah.
So the 3% down, you have mortgage insurance, and they price that into what the rate comes out to be. So that way you can afford, the house you're trying to purchase. It makes affordability a little bit higher.
Okay.
So if you're doing 20% down, they're like, well, he's not carrying mortgage insurance. So, hey, we'll make the rate a little bit higher, right? It's a give
Seriously?
and take.
Wow. I did not know that. Okay. All right. Keep going.
Yeah. I mean, it's a way that they provide affordability. And most people look at it as like, well, I put down my 20%. I should have a better rate. And it's like, well, I don't know. I feel like there's a community aspect to this whole thing and ensuring that everybody can buy a house, right? And the affordability remains as good as it can. But it starts there. I'll send you, an application link. You fill it all out. It's going to ask you for everything. Your birthday, social, everything, work history, where you've lived the last 2 years, because it's all about twos. That's how you can look at a mortgage application.
Okay.
Everything's in twos. Where have you been the last 2 years? Where have you been working the last 2 years? Last 2 pay stubs, last 2 statements, last 2 retirement statements, last 2 years of W-2s, last 2 years of tax returns, right? It's about 2. And then all that comes into me, and it'll take me about 1 to 2 hours to look over everything, depending on the complexity or no complexity, and put it all together. And then I'll give you a pre-approval after our Zoom call. And then whoever your realtor is, they'll start taking you and showing you houses.
Okay.
And you'll go and you'll look at houses and you'll be like, this is the one. And then you'll make your offer on that house. What happens after you make your offer is that in the contract, it states what your earnest and option money are going to be.
And what's the difference?
Earnest money is tied to your financing period. So if you don't get financing between, execution date and 10 days or whatever, then they get to keep that earnest money.
Oh, I see.
Because it's earnestly showing that you want to purchase the property, right? And that typically ranges between, 1%, and I've seen some a lot lower than that, but the general rule with them is 1%.
Does that lock in you're a customer for that house, I guess?
Yeah, it technically locks them in saying, hey, we're earnestly going to purchase this house, right? Earnest money. And then your option is just the option to exercise whether or not you do buy the house.
Sure.
So you get like maybe 7 days for option, which means you can submit inspections, do everything you want to do in those 7 days to make sure the house is in a condition that you want to purchase. And if it's not, then you can axe it and all you're out is option money. No matter what, you're always going to be out option money.
Okay.
Earnest is tied to financing, which is usually 10 days after.
How much is option money usually?
1% of purchase price. So if your house is $300,000, $3,000.
Okay.
And you just submit all that to title. Wherever the title company is that's been opened, that's where you send all that money to.
Okay.
And once you've done that and you've done your due diligence, I will have already reached out to you and said, hey, here are your 3 options on how you get this loan done. And when I say 3 options, I don't mean like, all right, you can use this type of loan or this type of loan. It's like, all right, we've already established that you're going to be a conventional buyer. And here are 3 different options on how we get the conventional loan done. This one has no rate buy down. This is your par rate. This one has 1 point. And this one that nobody ever picks has 2 points of buy down. Now, buy down is 1% of your loan amount.
Okay.
So if your loan amount's $200,000, that's $2,000 per point.
Okay.
And you can reliably look at it as it'll lower your rate by 1/8%, so 0.125. But I have seen it in other times where it does better than that, but pretty reliable for 1/8%.
So you're paying to get your loan down,
You're
loan
essentially
rate down.
prepaying interest.
Okay.
Yeah, that's how you can look at it. You're prepaying interest, and it doesn't go to me. It goes to the bank or whoever's going to be servicing that loan thereafter. Sure. And after that, you'll digitally sign all your docs, and that allows me to be able to get to work on the other side of it, which is verify employment, order the appraisal, and all the other pieces to it. And we'll do that. And during that time, it's honestly just a big hurry up and wait moment. And then it goes to processing for us, and our processor gets it all ready, puts it together, and then sends it off to underwriting.
Okay.
And then underwriting looks at it and makes sure that it follows all of the guidelines for whatever type of loan we're doing. And sometimes you get weird things back, and they're like, hey, we need an explanation on this. We need this. We need that. And it's like, okay. And then you got to go back to your client and be like, hey, I know this is really weird, but can I get this document from you or something? Because like they'll find something. That's their job.
Okay.
Is to make sure that no one can rebuttal the servicing of the loan. That's
what are some
job.
examples of weird things that they found, I guess, or that you've seen, I guess?
I mean, I've seen one where this guy had a mobile home on his credit under title. Like it didn't show up on his credit report, but when they do it, what is it? I forget what it's called offhand. A fraud report.
Okay.
Popped up that he owned a trailer. And we're like, what? And he's like, what? So we had to trace it all down. So it turns out it was, he was put on title for a trailer that he's never lived at. I think it was like a mom or a dad or something that they had this trailer and they wanted to make sure that if they should pass, it went to him. Mm-hmm. And so pulled up on the fraud report. Yeah, it looks like he's owned a house, but he'd never been there. So all we had to do was get documentation from the parents showing that, hey, this was.
So he had no clue this was happening?
None.
Yeah. Okay.
No, which made it even funnier. But like his parents were just preparing for whatever could happen,
sure,
right?
Sure.
They're like, hey, we're just going to do this. We're going to do this, going to do this. And I mean, that's one of the weirdest ones. I mean.
Why is that important though?
Because if he owns another property, we have to have a payment for that property, right? Okay. Which could upset what we call debt to income ratios.
I see.
So if they're still paying on this thing and he's on title, that means he's kind of liable for its payments unless we can prove somebody else has been making the payments.
Right.
Which we did. We proved all those things. Hey, he's just on title and everybody else is making the payments. He's never made a payment and stuff.
Okay. All right.
But it's not really the underwriting that has the weird stuff. It's the self-employed people that have the weird stuff. I mean, I have done a loan for, lack of better terms, a YouTube televangelist, where when you get into that hemisphere of the 501c3 and how all that stuff works, it's very, very weird. And the things that they do and what you try to prove are insanity. I mean, they have and they're making and everything's good, or at least should be, but it's not proven anywhere because it's really not filed for.
So they're earning money off their YouTube channel.
Mm-hmm. Which then gets funneled back into, say, a 501c3.
Right.
Right. Which doesn't pay taxes.
Right.
And then.
But they still have to prove income, though.
Uh-huh. Oh, yeah.
Okay.
Trust me. It's unreal difficult. But we did get that one. We did get that one closed. But yeah, that's where the weird stuff is like the initial pre-approvals.
Okay.
That's where the crazy stuff is. Because I can pretty much tell you what'll happen once it goes from here to here to underwriting, right? Because I'm batting at basically 100% loan closes since I started in 2019. Never had a single deal die. But I mean, I had one, but that was not my fault. That was a bad deal, and they just ended up, we couldn't do it because they had made a bunch of repairs to the property and then tried to like up the value. It was a mess, but we didn't do that one. So I guess I'm batting at 99.9%.
Right, right.
But that one's totally out of my control. I mean, I can pretty much know where it's going to go from initial pre-approval to whether or not it's
Just by looking at the numbers. Yeah.
just by looking at everything. Yeah. I mean, once you've done enough of something, I mean, there's always things that'll pop up that you'll be like, oh, I didn't know that. And you'll learn something, right? But outside of that, I mean, it's really cut and dry on the rules for buying a house. So as long as, the three legs all work out on the stool, which is, income, money, and credit, I mean, you pretty much do what you need to do.
Okay.
Everything else in between can be figured out.
And then after the underwriting, what happens?
Either it's issued a clear to close, meaning they can go ahead and close on the house when the closing date is or before or whatever, or it'll get an approval, which means it feels good. We feel like there's a deal here, but we need clarification on this, or we need this documentation or whatever.
Okay.
And then after that, I mean, it's done.
Right.
Clear to close. We send out the CD, per government guidelines 3 days before. You got to have it out 3 days before closing. And then we go to closing and then sign off on the dotted line. But what's really cool about where I work is, and this is not for the first-time home buyers, so don't do this first-time home buyers. We can close in like 15 days if we need to. And that's not something a lot of companies can say at all.
Okay.
Most companies are at a 30-day lead time period.
What's causing that discrepancy in lead time, I guess?
So we have everybody in-house. Our processors are in-house. I know them. We're friends. Our underwriters are in-house. I know them. We're friends. We fund all of our own deals in-house. We're not waiting on a bank to fund. And that's what separates it. I mean, we're an efficient machine when it comes to that stuff.
So a lot of loan companies will outsource that stuff and they have to wait.
Yeah.
Okay.
Yep. And they'll have to wait because somebody's got 25 deals they're rolling through, and it's like if you need something to move to the front of the line, I mean, they'll make accommodations to make it happen.
And is that a question you should ask a loan officer? Like, do you have all this in house, or do I have to wait, or will they even answer that question?
I feel like that matters to you, right?
But that doesn't matter. You're saying, I guess.
I mean, it matters in like, let's say you found a house that you really like, and the seller's really desperate, and you make an offer that's probably pretty low compared to maybe what they want, but also they're on a tight timeline.
Yeah.
And now all of a sudden your offer looks really good because you can close in, 13, 14, 15 days.
Right.
And it's like, oh, I don't have to wait a month to close this thing. I can close it in 2 weeks. Maybe it is worth it,
Yep.
I mean, if you're looking for an advantage, I should say, with your offer, that's really where it comes in handy.
Okay.
Outside of that, like I said, industry, norm is probably 25 days, 25 to 30 days, which again, gives people a lot of time to ruminate on things, think about stuff, blah, 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 right? That's why I say first-time homebuyers really shouldn't do that because it's just too fast through the process. They'll just be like, and they'll not know what happened to them.
So in those 25 days, you can cut the deal off, but you just lose your earnest money.
Yeah.
Okay.
You lose earnest and option, especially because 10 days after is the usual amount for earnest.
Okay.
Which is tied to the financing contingency.
Sure.
And
okay.
Yeah, that's it.
All right,
but I mean, you can also drop for several other things and get your earnest money back.
Can you give us examples of that, or?
So things that I've seen that have done that is like the appraisal came in really low, and everybody's like, okay, well, we have two choices here. We can either bring more money, which we're not going to do, or you guys can lower the purchase price. And they're like, we're out.
What is?
They give us back their earnest money.
What is considered a really low appraisal?
Yeah. So I mean, if the house is for sale for $300 and it appraises for $270, I mean that's pretty low. I mean,
that's pretty low.
$30,000 swing, right? Which means the house is probably not worth $300. So they're going to run into that problem more than just this one time.
Who hires the appraiser?
So the appraiser is a third-party board of appraisers.
Okay, so they're independent.
So we set it out to like the board of appraisers, and someone picks it up.
Okay.
Like, hey, okay, we'll go grab this house in Plano and we'll go look at it.
So they shouldn't be beholden to the seller or the buyer, the appraiser. They're just
they're not. Okay. They're so far removed from everybody. It's crazy. Okay. I mean, you can't. Technically, you're not. No one's supposed to really talk to the appraiser. The appraiser just goes out, does their thing, comes back home.
Okay.
And sends out an opinion of value. So what really does well is when the appraisal comes in for FHA, it's very specific to FHA, and it is low, that appraisal sticks with that property for 90 days. So there's no way they'll be able to sell it to somebody FHA because there's already an appraisal on the property. They'll have to bring the price down. So 9 times out of 10 on when you're in that situation with FHA, they will lower the price. No
So as a
questions asked.
buyer, that's one of the first things you should ask. What was this appraised for, right? I mean,
Well, if they have it, right?
Right.
Like they may not. Right now, especially they don't have it. I mean, there's been no other offers made. I think my favorite thing about this market right now is when we hear, we've got other offers. And we're like, but you don't. Like, I'm pretty sure that you don't. And we're your only offer, probably. I mean, your other offer was an investor offer, and you're not going to take that anyway. But you're just saying you have an offer.
so this is a game the realtors play, I guess.
Oh, brother.
Yeah.
The games that they play with each other, I am not here for it.
Aren't they bound by rules to disclose properly, or they can play these games? Or
I mean, I think at the end of the day, it's all about negotiation and the fiduciary responsibility to your seller or your buyer, right?
Okay.
And so if it's helping protect equity for the seller, then, I mean, I don't know. I guess it falls into a morally ambiguous gray area.
I see.
I wouldn't do it personally. I would just be like, hey, I mean, we don't have any other offers, but like, we can't do this.
So there's no legal requirement for them to say either
No,
way.
you can't know what the other offers are either,
Oh.
right? So, like, if you go to buy a house, your realtor can't tell the other realtor what the other offer is.
Oh, wow.
You just tell people, hey, best and final, buy X, and that's it.
Okay. Wow. All right. I have a question that kind of relates to me. I just always want to ask somebody in the home loan business.
Yeah, what you got?
So I'm close to paying off my house. When that happens,
Congratulations. What a
how do I
flex.
get the title?
How do you get the title?
Yeah. Do they send it to me?
You ever paid off a car before?
Yes.
So you already have the title. You just
It's just not physically in my hands, or
you want physical title?
I can just give. It's just somewhere on the database somewhere that I own the house, or
Yeah.
how does
It's
that
on
work?
it's on your county's appraisal district.
As soon as the mortgage is
So-
paid off, it automatically happens.
Well,
or?
the title's already been made. You just right now it has a rider for somebody
Right.
on it, which
Well-
is whoever the servicer was.
Right, whoever I'm paying the mortgage
Mm-hmm.
to, right? So when does that come off the title?
As soon as it's paid off, brother.
And it happens like automatically, or do you?
Yeah,
so-
they'll file it quickly. Mhm.
Okay.
I wouldn't even worry about it.
And so if I just wanted to go to the county and get a physical copy, I could. But no one sends
And
it
frame
to you.
it.
No one sends it to you though, right?
No, it's
Okay.
I mean, they might. I mean, it's like I think about cars, right?
Mm-hmm.
So whenever I paid off a car, they always send me the title in the mail pretty quick.
Okay.
So I mean, I would think of it in terms of that. I've never had that question before. See,
that-
this is the
Do they do that with homes?
sounds about right to me. Why not?
Okay, all
Why
right.
not, man?
I just
But there's no
wondered- I was just
vehicle data.
curious.
Well, because like think about your house, right? It's going to be in that database forever, in perpetuity,
Right.
because you have to pay property taxes, right?
Okay.
Cars, once they're paid off, right?
Yeah.
So there's no database that keeps them in there forever to pay taxes against.
The only reason that question came up with me and my wife is because we were watching a video about like squatters in other states. And I'm
Yeah.
like, you own the home. How is it that someone lives in your home, and then when the authorities come, they can't get rid of that person? Like, you have your name on the title of
Yeah.
that house. Like, what is going on? So we just started talking, and this question came up. I was just
Yeah.
wondering, like, how do you prove you own the home, right? So-
Yeah, it's in a database, man. I mean, I
Okay.
can prove I own my home, same as Sumner can prove he owns his home.
Right, right. Okay.
It's on the database on the CAD, on your appraisal district website. It tells you who owns the house. Who has
But
the
legally, you don't own the home if you're still making mortgage payments on it.
title. No, technically you do. I mean,
Technically you
it's
do? Okay.
It's one of those weird things where everybody's like, when you fill out a form, do you write down that you rent your home or that you own a home?
I
Because you
own a
only
home.
have those two options,
Right.
So technically, you own the home until you stop making payments.
So if I don't make my payments, though, the bank could legally take it? though?
Absolutely.
Right. So I don't really own my home if I'm.
Hey,
still
I'm telling you what the drop downs say. You know what I'm saying?
Right.
The drop downs say own or rent.
Okay.
So you own, but you're about to free and clear own. How about that?
Right.
Because like if you sell your house, where does the money go to?
Right.
Does it go to you or does it go to the bank?
They get
What
whatever
they're owed,
what they're owed,
nothing else.
and nothing else. Yeah.
So you get to enjoy the equity. So you own
Right.
the home.
Right. Okay. All
That's
right.
how I look at it.
I just wanted to ask. That'd be interesting. We just had a light malfunction, but that's fine.
It's probably helping with the glare.
So how about let's end with this. Give us your best advice for someone who's purchasing a home, what they should do, how to make the process smooth, and then we can end with that, I guess.
If you want a really smooth home transaction, it's simple. You need to have a realtor and a lender that both align with you on what your goals are.
Okay.
And if your goal is to get the best price on a home, those are the people you need to align with. Don't align with anybody who's got crazy commission breath. Don't align with anybody who's not going to hit your goals. So if your goal is, I want to buy a house as cheaply as is humanly possible, I want to put out really stupid, weird offers, find a realtor that aligns with that. And if your goal is to know more about the mortgage process, understand everything, align with somebody who will be in that process with you.
Okay.
That's the biggest thing you can do. You need to be with people that align with your goals and your values. Outside of that, it's whatever.
All right.
Because if you don't do that, then, I mean, honestly, it's going to be a really rough transaction. If you do not get along with people you're working with, it's rough. I mean, you're basically buying a Lamborghini and you're surrounded by people that you don't like. So, you know, I only work with realtors that I personally get along with and I'm friends with and I do life with. I don't defer from that because that's when it becomes a job and a chore. I only deal with people that I like and hang out with them.
All right. Well, I think that's a perfect ending. All right. Well, thank you so much, Ian. This was really informative for me, actually. So,
Hey, my pleasure, man. Thanks for having me out.
all right. Thank you.